one.
Welcome out to Tackle Trading 101, Beginner's Guide to Trading Options. This is Coach Matt, and it is an absolute pleasure when I can figure out my screen here. It is an absolute pleasure to introduce somebody that is near and dear to my own heart, near and dear to many of you at Tackle Trading in our community, and that is the great, and I mean the great, Tyler Craig. Very few traders do I know that can read a chart and apply an option trade better in the combination of those two forms of analysis than the great Tyler Craig, a master market technician, certified market technician actually, but a master technician in how he reads charts. He's been a mentor, he's been a coach, he's been a designer of option systems in the past. The wonderful, the great Tyler Craig is here today to teach all of Tackle Trading's YouTube community a little bit about basic options. This is Tackle Trading 101. It is a series we are going to do every other week on Mondays for the next few months as we put out some great beginner level content for our Tackle Trading YouTube community, because we know our pro member community, they might not need some of the basic information, Tyler, but some in YouTube certainly do. I am looking forward to you rocking and rolling on basic options. But before we get into that, guys, Tackle Trading is a pro member community, and if you have interest in becoming a member of tackletrading.com, you can email us at team@tackletrading.com. You can get a 15-day free trial of our pro member community where you can get access to all of our scouting reports, our Tackle Trading newsletter, all of our different coaches shows, webinars, mastermind groups that we do with our pro member community. In fact, Tyler, no kidding, I just got out of a webinar for the mastermind for the STEP system. It is a swing trading mastermind group. Love being there. Wish I could have done there more. If I wasn't doing your intro today, I'd still be over there talking about front running Goldman Sachs breakout. We were doing a little front running techniques, Tyler. You would have appreciated it. You also get access to all of our courses. Yes, I am going to lay out everything you get at Tackle Trading because Tyler's going to give you that great free content here. Blogs, tools for traders, playbooks, trade journals, you name it. And guys, once again, if you want to join Tackle Trading as a pro member, bit.ly/join-tackle-pro, and or email us at team@tackletrading.com. And with that said, I am going to get out of the way here, Tyler, and I'm going to watch you fly, my friend, as you take over and teach our community on YouTube just a tremendous amount about the options market, but specifically the basics of options. Tyler Craig, my friend, enjoy.
Yeah, thanks, Matt. All right, friends, let's get to it. Appreciate the kind introduction there. We're going to see how much I can explain and discuss here with option basics. I'm going to take some notes, going to draw some pictures, going to hopefully make this lively and entertaining and engaging. Normally, I'd be throwing out questions and doing some back and forth, but there's a little delay on YouTube. So mostly you're just going to sit back and relax and listen to me do the talking here. But I may throw out a question or two, and I am trying to monitor YouTube here. So feel free to be a participant and be active there in the chat channel there for YouTube. All right, so options 101. Let me set the table here for a second. This is going to be a fairly basic introduction to the options market. And it's a challenge for me for a couple of reasons. I tend to dig deep into the more advanced stuff. In my Team Phoenix Trading Lab, we do lots of interesting cash flow strategies. But if you want to be successful at stuff like that, you've got to have a good foundation. You have to understand the nuts and bolts of how options work. And I want to present this as the nuts and bolts of how options work. In particular, we're going to talk about a call option. So what you should get from the next 40 minutes or so is a very good understanding of what a call option is, how do they work, how are they priced, how can you use them in your trading, right? How can you use the long call in your trading? Once you understand that, it's one of the basic building blocks of more advanced trades, and you can kind of build on that. But call options, first and foremost, are going to command our attention today. Let me start with why someone might want to use a call option, okay? Let's say you've got a stock that you like, and maybe the stock's trading for 125 bucks. And you're bullish, meaning you think that stock's going to go up in value. The traditional way of taking advantage of that is to buy the stock. And if you wanted to buy 100 shares of that stock, think about how much that would cost you. Not cheap, not cheap. 100 shares of $125 stock would be $12,500. Because we've been in a bull market, the stock market's gone bonkers since 2008. We're now like 13 years into a pretty vigorous run higher. Some stock prices have gotten quite expensive. So you may be wondering, is there a cheaper way that I could control this stock, that I could capitalize on an upward movement in price? So that's going to be part of your motivation. I want something that's cheaper than buying stock. When you build a trade that's cheaper, it simultaneously means you have less risk. Simultaneously means you have less risk. So maybe you want a less risky way of taking advantage of a rise in price in the stock, something less risky than buying shares outright. And finally, because you're able to build a cheaper trade, a less risky trade that still has a lot of exposure if the stock goes up, it ultimately means you have more leverage. It ultimately means you have more leverage, where a small move in the stock could result in a very large profit. So if somebody were to ask me, hey, what are kind of the top reasons why you would use a call option as a vehicle to be bullish as opposed to buying a stock, I think these would be three really good reasons. Okay, these would be three really good reasons. So if that's not appealing to you, if the idea of building a cheaper trade isn't appealing, if the idea of having less risk isn't appealing, if the idea of having more leverage is not appealing to you, then I don't know what is appealing to you, because quite frankly, I think anybody who has a pulse would find those objectives worth reaching for. So ultimately, we're going to come back to this. We're going to come full circle in the end, and I'm going to show an example of how you might build a call option trade on a stock around 125 bucks. I'm going to show you what it looks like in a brokerage account, how you put in the order, and show you the application of the theory. But before I do that, in order for me to go buy a call option, I have to understand what I'm dealing with here. So we have to take a look at what the actual definition of an option contract is. Okay, and specifically, we're going to look at this from the perspective of a call option, because there's actually two types of options. There's calls and puts. Okay, and we're going to have to put puts on the back burner here because I don't have 3 hours. I got 40 minutes. So we're going to focus on call options. A couple things you need to know. First of all, a call option is a contract. You do not buy shares of options like you buy shares of stock. You buy contracts. You buy 1 contract. You buy 2 contracts. You buy 3 contracts. You don't buy shares. And anytime you enter into a contract in real life, in the non-financial world or non-stock market world, there are, well, specifications that detail what your rights and obligations are. So if you want to really understand what's going on with calls and puts, you got to look at the contract. So we're going to go through the definition here. Okay, so a call option is a contract that gives the buyer, and that's what we're focusing on today, is buying a call option. It's a contract that gives us, the buyer, the right to do something. Now, I want to tell you that it's a right, not an obligation. So often we'll say you have the right, but not the obligation. You don't have to do this if you don't want to, but you do have the right to buy stock. It's a contract that gives you the right to purchase stock. Well, what stock are we referring to? You'll notice, or you'll discover that there are call options listed on a ton of different stocks. You can buy call options on Apple or Microsoft or Netflix. Okay, they list these on tons of popular companies. You have the right to buy those stocks at a specific price. So there's a price that's specified. Do I have the right to buy Apple for $100 or for $50 or for $500? It's specified in the contract. These contracts also have expiration dates. They don't last forever. So I have the right to buy this stock at a specific price on or before a specific date. Kind of a mouthful. Kind of a mouthful. Okay. We're going to get into each one of these. We're going to break this down. Okay. But remember, this is the base definition. This is your basic contract specifications here. So let me draw out a picture. I thought it would be helpful to pretend like you and I are creating a call option. Okay. So first of all, let's draw me. I'm really good at stick figures. Okay. See if you can see the resemblance. All right. This is me. I'm going to purchase the call option. So I am the call buyer. I'm going to buy this contract. Okay. And, well, I mean, contracts usually come in pages, right? So here's the page that specifies the contract. What does that contract give me the right to do? What does that contract give me, the purchaser, the right to do? Well, I have the right to buy stock, right? That's what we said the contract does. I have the right to buy stock. In this case, I'm going to pretend like Apple is the stock we're talking about. So this call option, right? This is a call option. The stock that we're referring to is Apple. That's the stock it gives me the right to buy. Now there's a specific vocabulary term that we refer to this stock as, and that is Apple is known as the underlying. You guys can write underlying in the chat window if you want. Apple is the underlier. That is the asset upon which the contract is based. So just as a side note, options are sometimes referred to as derivatives. I'm actually going to put that up here. An option is a derivative. It derives its value from something else. And so the reason a call option on Apple has value is because Apple stock has value. We're building this agreement off of some underlying asset. So Apple is the underlying. Okay, that's the stock that I have the right to buy. Well, don't you and I need to agree on what price I'm going to purchase Apple at? Like in the stock market, Apple's trading for 125 bucks. And we could set that as the agreed upon price, but we could also say, hey, Tyler, you've got the right to buy the stock at 100. Or let's build a contract that gives you the right to buy the stock at $130. So you'll discover that there's lots of different call options set at lots of different prices. And the specific price at which I have the right to purchase the stock is known as the strike price. So let's add that to the vocabulary. There's the strike price. And depending on where that is, it might influence how much this contract is worth. So Apple is my underlying. And the strike price, let's assume Apple's at 125. Let's say the strike price is 120. I'm going to lock in the right to buy Apple for 120 bucks. Now let me pause for a second. If I'm buying Apple for $120, if I have the right to do that, who am I buying the stock from? As with any agreement, there's somebody on the other side of this trade. That's the call seller. Okay. And we'll give the female some representation. I'm really good at drawing females, as you can tell. This is the call seller. If I have the right to buy stock, the call seller has the obligation to sell the stock to me. So, on a side note, when you sell call options, you can actually be the call seller if you want to, but today we're focusing on the call buyer. When you sell a call, you're obligating yourself to sell stock. So in this case, I have the right to buy the stock at 120. And I don't know, what should we call her? Sally, maybe? Sally, I got to give her a name. I like the name Sally. Sally has to sell me the stock at 120. That's the strike price. Now, what else with the terms of the agreement here? What else do we need to specify? Well, how about time? Is this contract going to last forever? Do I have the right to buy Apple from Sally for the next 100 years? We could set up a contract that specifies I've got the right for 100 years. What you'll discover is the standard is basically anywhere from like a day or a week from now to maybe a couple years from now. So they actually have contracts on Apple that expire anywhere from maybe the end of this week to next month, the month after, the month after, the month after, a year from now, 2 years from now, sometimes even 3 years from now. And you can choose, what do we want the deadline to be? When do we want this contract to expire? Right? So it's somewhat arbitrary. You and I can choose whatever we want. Let's say it's 1 month. Say this is a 30-day contract. So it specifies what we would call the expiration date. That is a key component of an options contract. Expiration date. Okay. Now, I've got the right to buy Apple for 120 bucks for the next 30 days. I'm the call buyer. Why would I do that? Like, why would that be interesting to me? Locking in the right to purchase Apple for 120 bucks. Well, look, first of all, right now, the stock's at 125. Stock's at 125. So if I lock in the right to buy this stock for 120, I'm already locking in the right to buy it at a $5 discount. Rest assured, you're going to charge me for that. That's not a freebie for me. You're going to say, look, Tyler, if I'm obligating myself to sell the stock to you at a $5 discount, you got to pay me something for that. So this option is going to be a little more expensive versus if we set the agreed upon price at 130. But regardless of what price I'm locking in the right to buy the stock, the only reason I would do that is because I'm bullish. I think the stock's going to go up. So because I think the stock's going to go up, I want to lock in the right to buy it. I mean, just think about like houses. Housing values in my neck of the woods have been going bonkers over the last couple of years. And so if I could, in hindsight, I would like to go back 2 years ago and lock in the right to buy a house in my neighborhood at the price it was trading at or valued at 2 years ago. And I'm telling you, that contract would be worth a ton right now. In a similar manner, as stock prices go up, call options go up in value. Because right now, locking in the right to buy Apple at 130 may not seem that big of a deal, may not seem that attractive, but what if Apple goes up to 150 bucks or 170 bucks? When you have the right to buy something at this price and it goes way up to this price, your contract, that right that you have to purchase the stock, is quite valuable. And so a call option will go up in value as the stock price rises, because you've locked in the right to buy the stock at a set price. Okay, so think about the price tag. What are you going to charge me for this contract? Okay, what's the price tag? We call this the premium. Like, how much is the option worth? The market premium, or you might think of it as the cost of the option. Right? Cost of option. And I'm actually just going to say premium. How much is the option worth? I don't know off the top of my head. We can make up a number. Okay. And what's important here is what would cause that number to go up or down. So just quick thing here. Let's say that this contract, I'll tell you this, if the strike price is $120, the contract's going to be worth at least $5. Because it gives me the right to buy Apple at a $5 discount. You're going to charge me at least $5 for that. Okay. In trader lingo, we say that the option is in the money. It's in the money. I have the right to buy the stock at a lower price than what is currently available in the market. right? It's currently 125. If we were pricing an option where I had the right to buy the stock at a higher price than was currently available, that'd be a cheaper contract, okay? And we would refer to that as it being an out of the money option, because it doesn't give me the right to buy the stock at a discount. So this particular contract has an in the money strike price. It's going to be more expensive, okay? So I know it's at least $5, but let's say right now it costs $6. You might say, well, why would it cost more than $5? Again, it's only $5 below the current stock price. You get a $5 discount. Why would it be $6 or $7? Why would you pay more than that? And in this case, the answer is primarily because it's giving me 30 days of time. Think about time for a second. Wouldn't you like to lock in the right to buy Apple at $120 for the next 50 years? Or buy the S&P 500 at the current price for the next 100 years, right? I mean, it would be nice because in 100 years or 50 years, if you're really bullish on this company, if you think it's going to go up in value, you could make a lot of money. So naturally, the person who sells the option is going to charge you for that, because they're obligating themselves to sell the stock to you at what could be a really low price in 50 years. So it turns out that the more time in the contract, the more expensive it is. 30-day contract, probably not going to be all that expensive. Now, if we change this to like a 1-year contract, there was a year of time, right? Then this might be more like, I don't know, $12 instead of $6. Okay. So one of the complicated, maybe complex things about options is you have all these choices. The stock trader, I mean, look, stock traders are playing a very simple game. It's a very simple game. Do you think the stock's going to go up? Buy the stock. Do you think the stock's going to go down? Sell the stock. And everybody's trading the same stock, right? Are there multiple apples to buy? No, there's just one, AAPL. I buy the same apple as you. There's only one way of buying Apple shares. The options market's different. There's hundreds of options on Apple. It's overwhelming. So what we tend to do is just create basic rules. Hey, if you're a swing trader and you're really just looking to be an Apple for a week or two, maybe buy a 2 or 3 month option. You don't need to buy 6 months. You don't need to buy a year, but you probably need to buy more than 1 week, right? So maybe buy a couple of months. And then what about all these strike prices? You know, the stock's at 125, you could buy the 120, you could buy the 130, you could buy the 140, and there's tons of choices. How do I know which one to buy? Well, good rule of thumb, good place to start is to buy maybe the first strike in the money. Maybe the first strike in the money. So if you want a basic rule, and again, it's very hard to overgeneralize here because we're all different traders and we have different time frames and everything. But in general, I think a good swing trading rule. Okay, I'll put it down here. A little swing trading rule. Swing trading just means we think that the average duration of the trade is going to be maybe a week or two. You're not going to be in the trade for 3 months if you're a swing trade. That's all the time you need. You know, maybe you buy maybe 2, maybe to 3 months. And you buy 1 strike in the money. Buy 1 strike in the money, which essentially means it's the first strike price below the current stock price. Okay, 1 strike ITM. I think that's a good set of rules to start with as a swing trader. And then as you evolve and as you get more understanding of how options work, you may come up with reasons why you want to deviate from that. But it's a good starting point. It's a good starting point. Okay. Okay, am I missing anything else on this situation here? Let me add a couple other things, okay? Again, the objective isn't to tell you everything. Can't do that in 40 minutes. The objective is to help you have a better understanding. What is a call option? Why would you purchase it? Okay, we'll talk about the how here in a second, but just kind of want you to understand the math, okay? And throw out some vocabulary. A lot of these are threads you're going to continue to tug on. You know, we expand on this in the Options 101 video series over at Tackle and a bunch of our classes. But fundamentally, you got the basic idea here. So a couple additional things that come to mind. Sometimes you'll hear about the option Greeks. Okay, I don't know if I can get a color that corresponds with Greeks, but we're going to go with red. Okay, the Greeks. Now I know my blackboard's filling up here, but bear with me. The Greeks have to do with the pricing model that you use to price an option. Okay, so back in the 1970s, 1973, I believe, three mathematicians, Fisher Black, Myron Scholes, and Robert Merton, put their heads together. They created this pricing model. They called it the Black-Scholes model. And it was used to price options or derivatives. And there's specific pieces of information you need to price an option. I've given you some of the inputs here today, the stock price, the strike price, the expiration date. There's actually six. There's 6 inputs. And so using that pricing model, you can come up with what are called the Greeks, and they help you understand how the option is going to behave. Okay, they help you model the risk in the position. So for instance, I bet some of you have heard of the Greek delta. And this is actually a Greek letter. You see it in math classes. They'll use a triangle to designate delta. And often in math, when you see that triangle, it refers to the rate of change, right? The rate of change. Delta measures how much this call option will go up in value if the stock price rises $1. So if you want to model out how your call option is going to behave, then you look at delta and you say, oh, this call option has a delta of 0.6. So that means if Apple goes up from 125 to 126, this call option is going to go up 60 cents. I think 60 cents, that's not a lot. Am I in this trade to make 60 cents? Well, I forgot to tell you something. What I should have said at the beginning of our conversation is, in this contract, I don't just have the right to buy 1 share of Apple at $120. The contract actually specifies that I can buy 100 shares of Apple at $120. That number 100, here's a new vocabulary term, that's the multiplier. That's the multiplier. By default, option contracts give you the right to purchase 100 shares of stock, not 50, not 1, not 20, but 100 shares. And so when we say that this call option is going to go up 60 cents, or that the delta is 0.6, that is per share. So the whole contract will actually go up $60. That's interesting. So if the stock goes up $1, the option contract will go up $60 if it has a delta of 60. So sophisticated, more veteran option traders will maybe use delta as a guide to, base their expectations on how much is this option going to move? How much risk do I have? Because the stock could go down in value too, right? If the stock goes from 125 down to 124, then I might lose 60 cents per share, or $60. So the delta helps us understand our directional exposure. D for delta, D for direction. And you could go down the rabbit hole with delta. I mean, you can look at the delta of your entire portfolio. It's a risk metric. Say, I know how much exposure I have because I can measure the delta of my portfolio. All right, so that's delta. That's delta. Another Greek that you'll hear about is theta. Okay, theta. Now, I can't remember how to draw theta, the Greek letter. D was for delta for direction. T is for theta. T is for time decay. Let's think about this for a second. This should be intuitive. If a call option has 30 days to go, is it going to be worth as much when it only has 3 days left? Is locking in the right to buy a stock for 3 days worth as much as locking in the right to buy the stock for 30 days? It's not. So you would think that as time goes by, eventually this 30-day call option will be a 3-day call option and a 1-day call option. And the value in that premium, the price that you're paying for the option, it's going to kind of go down a little bit as time passes. And that's known as time decay. Options are decaying assets. Okay. It's interesting because stocks, kind of by default, particularly if the stock pays a dividend, that they're appreciating assets. If you own a stock that pays dividends over time, the longer you own that stock, generally, the more money you make. Right? It's like stocks have what we would call positive theta. The longer you own the stock, the more likely you are to make money, or the more money you make. Call options are kind of the opposite, because that time component, it drops in value day after day after day. Okay, how much does the option lose per day due to time decay? The answer is, well, look at the theta. So let's say the theta number is -2. I'd say, hey, that option loses 2 cents per share per day. Well, there's 100 shares, so that option loses about $2 a day in time decay. So traders may want to measure that. And curious enough, time decay accelerates as you get closer to expiration. And so long-term options don't lose as much per day as short-term options. So you may go back to this rule here. Why did I say buy 2 to 3 months as a general rule for a swing trader? If you're only going to be the trade for a week or two, why even bother with buying 3 months or 2 months? Why buy more time than you need? Well, first of all, to give you margin for error, how many times have you entered a trade thinking it's going to take 1 week, but it takes 2 or 3 weeks to get where you need it to go? And then secondly, do you want to own a call option when time decay is really eating away at the value of the option, or would you rather be a little insulated from the impact of time decay? Longer term options aren't as sensitive to time decay. So even if I'm not going to be in the trade for 3 months, I may want to own that 3-month option for that 2-week trade because it's more stable. It doesn't drop in value as quickly due to time decay. So you start to see, man, this gets really complicated. Hey, all I wanted to do was make money if the stock went up. Well, true, you could just buy a call option, but look at what we've done. I've opened your eyes a little bit, opened you to a new world, and you discover, hey, if you want to, just buy a call when you're bullish. But things may happen, and you may not understand why they're happening. So if you'll be a good student and be a little curious and just dig a little further and learn things like the Greeks and learn about the vocabulary and the contract specifications, you put yourself in a position where you just better understand what's going on, right? You better understand. And then you can make better decisions. You can make more informed decisions. So the objective is not to overwhelm you or really deter you at the beginning. Quite the contrary, it's to whet your appetite and let you know that there's this whole new world of trading available that's a little bit more complicated than the stock market, just buying and selling stock. But there's a lot of really cool things you can do because you have more control over the way you structure risk. Buying a call option is the simplest thing you can do in the options market. Believe it or not, I'm sharing with you the simplest way of using options. There's things that are, a little more complex than even this. But this is the starting point. Okay. One other Greek, and then I'll show an example. Okay. So one other Greek here would be Vega. This one's a little trickier to wrap your head around. Think about this for a second. How would you price this contract? You got Apple, got the right to buy it at 120, got 30 days of time. I've got the right to buy 100 shares. Well, how much should the option be worth? Don't you think it kind of depends on how much Apple can move over the next 30 days? Like, isn't there a difference between if we were pricing an option on Walmart versus if we were pricing an option on Tesla? Would you guys agree with me? Walmart doesn't move that much. It's a consumer staple company, fairly stable business model, fairly predictable and consistent. And Tesla's crazy down, right? It's a very volatile stock, both up and down. So the range of outcomes for where Walmart can be in the next 30 days versus where Tesla could be over the next 30 days, night and day. don't you think then it would be more expensive to lock in the right to buy Tesla at a set price for the next 30 days than to lock in the right to buy Walmart at a set price? So that volatility expectation is going to be one of the inputs for pricing an option. Okay. And it's not really specified per se in the contract, because we don't really know how volatile the stock's going to be in the future, but it's implied kind of by the stock we're talking about, right? The inherent volatility of Apple or Walmart or Tesla or whatever you're building the option off of will influence or impact how much people pay for the contract. And that changes. It fluctuates. Sometimes Tesla is expected to be quite volatile, but sometimes it's not as volatile. Sometimes there's an earnings announcement coming up that causes the stock to move a lot. And so people basically bake that into their expectations. So as the expectations for how volatile the stock's going to be change, the option value changes. So Vega is the option Greek that has to do with changes in that volatility, specifically changes in what we call implied volatility. So D for delta, D for direction, T for theta, T for time decay, V for Vega, V for volatility. Okay. Final point here, and then we're going to do an example. Okay. And if I've done my job correctly, you probably will leave this discussion with more questions than answers. That's a good thing. That's a good thing. But you should have a pretty good understanding here, hopefully a lot better than when we started. Okay. Final thing I want to mention is when you buy an option. Okay. So let's fast forward. I'm feeling good about this agreement, Sally. Okay. I like $6. I'll pay you $6 for this call option. Okay. So I'm going to buy this call on Apple. I've got the right to buy Apple for $120. Okay. Now, over the next 10 days, I'm going to redraw Apple here, give us a little more space. Okay. Apple is $125 today. Over the next 10 days, Apple goes up to $135. Well, how much do you think having the right to buy it at 120 is worth? I have the right to buy Apple at 120. I got a piece of paper. I got a contract that guarantees it. Sally is obligated to sell me Apple at 120. And now Apple's at 135. I've got a big discount. I have $15. I can buy $15 lower than the current price. Isn't my contract worth at least $15? That $15, we say we're $15 in the money. That contract's $15 in the money. Another way of saying that is I have $15 of intrinsic value. Intrinsic value. So I bought this option for $6 and it proceeded to go up to $15. Could I sell the contract to somebody else? Could I say, oh, good enough. Somebody else can take my contract. I bought it for $6, I sold it for $15. I'll pocket the $9 difference. $9 profit. I paid $6, it went up to $15, I sold it, pocketed $9, which by the way is 150% return. I mean, Apple went up $10. My call option, which percentage-wise, by the way, that's less than 10%. I don't know what it is, 8% maybe. Apple went up 8%. My call option went up 150%. Nice. That's what I mean by leverage, right? So think about it. I didn't buy Apple stock. I bought a $6 option. It was cheaper. Instead of having, or $12,500 at risk, buying 100 shares of the stock at 125, I had about, what did I have? Is it $6? I should also mention this. When I say it's $6, remember that per share comment earlier? The multiplier is 100. This option is quoted per share. So a $6 option is actually $600. Okay, so to be more specific, I bought the call for 600 bucks. It went up to 1,500 bucks. I sold it and I made $900. So you can say it per share, bought it at 6, sold it at 15, made 9 per share. And the per share, there's 100 shares, right? So 9 times 100 made 900 bucks. Or you could say I bought the contract for 600, it went up to 1,500, sold it, made 900 bucks. By the way, same outcome. Okay, cheaper than long stock, less risk, put up 600 bucks instead of 12,000 and change. And leverage, stock went up 8%, call option went up 150%. Now, I just made up the number, okay? It's not like every time a stock goes up 8%, there's an option that goes up 150. Maybe the option went up 50% or 75%. Depends on the situation. But I can tell you, if the stock goes up 8%, call option is probably going to go up multiples of that. 16%, 24%, you know, et cetera, et cetera. That's the leverage component. Okay, that's the leverage component. Now, I am being optimistic here, showing you a winning example. The truth is you could lose. Stock might go down. But your dollars at risk are still less when you buy a call than when you buy stock. And so when you think about the risk versus the reward of buying a call option, your risk is limited to what you pay. Okay, me, the call buyer, okay, I should give myself a face. That's about right. I can't lose more than what I paid. I paid 600 bucks for the call. That's my max loss. My max gain, unlimited, just like long stock, just like long stock. So as high as the stock goes, at least in the next 30 days, you know, I make as much money as I can based on how high the stock goes. So buying calls is a limited risk, unlimited reward trade. Okay. Now, should we look at a live example? Matt, Matt's on here, so I'm gonna throw it out to him for a second. Any major things I missed here, Matt? Do you think we're ready for an example?
You know, I love examples. I love showcasing case studies and seeing the power of the options market. No, Ty, I was actually just eating, so I apologize for that.
You're good.
But no, fantastic job so far. Number one, understanding the Greeks is so vitally important here. Understanding how delta impacts the directional nature of the trade, how theta will mitigate some of the direction. And then the rules, everything about the options market is understanding the rules you apply to sidestep some of those landmines that the options market certainly does have with volatility, with theta, sometimes with delta. And so, no, a very good job so far, Tyler. Thank you so much for, I'll tell you what, there's not a lot of whiteboarding I love more than yours. You do such a fantastic job of it, so great job. But no, I have nothing more to add. I'm looking forward to the case study you got going on.
All right, perfect. Okay, case study. So I will also say this. I am not, the takeaway for me from this discussion is not, hey, Tyler's trying to convince me that buying call options is the best thing ever, okay? There's a time and place for every option strategy. Mm-hmm. Here's the beautiful thing about the options market. There are two sides to every transaction, okay? So if you're coming away from this conversation thinking, buying call options is the dumbest thing I've ever heard, I think that buying call options is a money-losing strategy. Guess what? If you really believe that, you can take the other side of the trade. Because one of you made the comment earlier, options are like a zero-sum game. There is definitely truth to that. There's also things that make it not a zero-sum game, but let's go with that for a second. If I win as the call buyer, Sally, the call seller, sorry, Sally, we love you, but you lost. If you think I'm an idiot for buying the call, go ahead and be Sally. Sell calls to people, and you can be on the other side of the transaction, okay? So it's not a matter of, is this the best strategy or is this a good strategy, bad strategy? You take whatever opinion you want, doesn't matter. The cool thing about it is you can place a trade. You can put your money where your mouth is. Whatever your bias is, good strategy, bad strategy, you can go find great strategies and deploy that strategy. Or if you think they're terrible strategies, take the other side of it, right? Take the other side of it. Same thing with betting in sports.
Can I add to that, Ty?
Sure.
Because I think it's a wonderful point. When you're talking about the zero-sum game of trading, right? There has to be winners and losers, and that's why you call it a zero-sum game. If you lose money, that goes somewhere. If you win, somebody else loses. Is that honestly true in the options market, though? That is only said as buyers. That is only said as buyers. Think about this as a wholesale type transaction in real estate. To a wholesale transaction in real estate, can the buyer and the seller of the contract both make money and both be perfectly satisfied with the transaction? Yes. In a wholesale deal? Because think about what a wholesale contract is. You find an underlying asset, you put as the buyer a contract that gives you the right to buy the property at a set price on or before a set date. You therefore have no desire to exercise that right to buy the contract. The only thing you're doing is selling it to a rehabber who is going to exercise the contract, correct?
Yeah. Yeah.
Which means both the buyer and the seller of the contract are perfectly satisfied with the transaction. And if you think about the buyer and the seller of the contract that way in the options market, you can also simultaneously get the same thing. Buyers and sellers can both be happy. If you're the seller of a contract in a covered call and you get exercised, you are not unhappy.
Yeah.
That's not how it works. You're actually fairly pleased because that's max potential in a covered call. The buyer's happy, they got price appreciation, the seller got the guaranteed sell of the stock price. Both parties can be extremely happy. So I just wanted to clarify that real quick.
Yeah, and that's where it gets complicated because it's like you don't know what else they have in their portfolio. If this was a game where you have one call option and nothing else, Tyler buys the call, Matt sells it to him, and they enter at the exact same time and they exit at the exact same time, and there's no other offsetting positions, then you could say, okay, Matt, look, I bought the call for $6. Okay. I got out of it at $9. I made $3. You sold it for $6. You had to buy it back at $9. You lost $3. Yes. In that vacuum, it was a zero-sum game. Mm-hmm. But to Matt's point, you don't know what he has. He owns the stock as well. So yeah, he lost $3 on the call, but he also made $600 on the stock.
Oh, just wait till these traders start learning advanced options and they start realizing they sell options against things they buy. This though is just the basic understanding of it.
And it is easiest when you learn about buying options versus selling in a vacuum to understand, what's good for the buyers, bad for the seller. That the idea of zero sum really helps it sink in when you're like, okay, the buyer versus the seller. Yeah, in the real world, it's just quite a bit more complicated. So great point. Great point. All right. So what I want to do then is let's see if we can find an example of a stock that I'm bullish on, but I want to buy a call option instead of buying stock. Okay. So I'm going to take a look, and I've already picked my stock. I got Dick's Sporting Goods here. And there are a lot of things to like about this. Look, I don't know what the stock's going to do. Okay. Ultimately, maybe I show this as the example and the thing goes to zero. I'd be very surprised. Okay. But not a recommendation, just what I think is a pretty good example. From a fundamental perspective, actually, let me go back to the data chart. Check out, I'm just like in awe of the earning growth. This is a really good example of fundamental and technical analysis both aligning, right? Fundamental and technical analysis both aligning. Got my little partner here. Hello, sir. All right. So check out the earnings. $2 fourth quarter last year, $2.43, $3.41, $5.08, right? So quite a bit of earnings growth coming in during the recovery, and no surprise, stock price goes bonkers, right? I mean, there's a reason why this has gone up tenfold. Okay. Now you could say, nah, too far, too fast, blah, blah, blah. Who cares? I don't know. I just know the trend is up. The fundamental growth has been propelling the stock higher. When you look at the weekly chart, here's where the compelling pattern comes in. Sure. Come say hi real quick. Say hi, guys.
Hi. Okay. Is that the dude? Did I see the dude?
That was the dude. That was Maxwell.
The dude.
Yeah. Okay. He's distracting. So the pattern, the weekly chart's gorgeous. This is one of the first pullbacks you've had, like weekly pullbacks in a while. Okay, first weekly pullback in a while here, right at the 20-week, turning higher. When you look at the daily chart, you've got a really nice, trend reversal, right? Really nice little trend reversal. Okay, see, this is the technician in me coming out where it's like, hey, you're teaching us options. I know, I saw a beautiful chart, couldn't help but comment. I like the breakout, I like the reversal, I like the pop above the 50 MA. Suppose you think this has a shot at getting back up to 140, 150. You think the longer term trend continues and then this pushes back up. Two choices. Choice one, you could buy the stock. Go buy 100 shares. Notice it's around $127. I specifically picked 125 for my example earlier on the blackboard because it's right around where DKS is. I don't want to buy the stock though. It's kind of expensive. I want to buy a call option. So let's use our guidelines. I'm going to go to the trade tab. And this is what I'm talking about with kind of being overwhelmed. Look at all these expiration dates. Okay. Do you want a contract that gives you the right to buy DKS for the next 4 days, for the next 816 days? Matt, I can go out to Jan 2024 for heaven's sakes. Like, you got a lot of choices here. But my guideline was go buy 2 to 3 months and assume this is like a shorter term swing trade. So I think I could buy December or I could buy January. Okay, 53 days out or 88 days out, whatever you want. Let's go with 53 days. Let's assume I'm looking shorter term here. You got call options on the left, put options on the right. I'm focusing on call options right now. Well, the stock, like we said, is 127.90. Look at these strike prices. Remember, these are all the contracts. You can lock in the right to buy DKS for 125, 120, 115, 110. A lot of choices. What was my rule or guideline? It was to buy the first strike in the money. The stock's at 127.90. First one below that's 125. I want to buy the DEES 125 call. Now, there's not one price. There's two prices. There's a bid price and an ask price. You buy the ask, you sell the bid. Okay. If I was going to buy this, and usually you try to split the difference and buy around what we call the midpoint. To make the math easy, I'm going to assume I could buy this for about 10 bucks. Now that's $10 per share. The multiplier is 100. It even tells me that right here. That 100 right there is the multiplier. 10 times 100 is $1,000. This call option would cost about $1,000. To bring up a buy order, I would just click on the ask price. Boom, pops open an order, says you want to buy one December 125 call option for, we're going to assume we can get it for 10 bucks. You say, oh, $1,000, isn't that expensive? No, it would have cost you $12,000. It would have cost you 12,000 bucks. Saying hi. All right. To buy 100 shares, right? So this is less than 1/10. This is less than 1/10 the value or the cost of 100 shares of stock. So it depends on what your perspective is, but my perspective is this is far cheaper, obviously, than the stock. And when I say perspective, let me elaborate. If you're comparing it to stock, it's cheap. Could you find something cheaper? Probably, right? But you know, this is just the one that we've gone with based on our rules. So if I buy this for $1,000, check this out. If I hit confirm and send, this is one of the nice things about Thinkorswim. It will tell me the trade specifications. Okay, maximum loss $1,000. That's the $10 times 100. Okay, so how much money do I have to put up? $1,000. Okay, how much money can I make? It's infinite. You have unlimited upside. You have unlimited upside. Okay. That's comforting to me because if DKS goes belly up in the next 30 days or 60 days, I don't lose more than $1,000. Okay. And yet I still have the upside. I still got the upside. All right. Let's talk about exit strategy and I'm going to wrap this up. Okay. Here's one of the nice things about buying a call versus buying stock. You don't really have to reinvent the wheel when it comes to where do you put your stop loss? Where do you put your target? You can really do the same thing that you do with long stock. And that's part of what makes a long call such an easy, maybe beginner trade for options. okay, is that you can not really have to rethink, okay, when do I get in? Where do I put the stop? It's pretty much the same thing. So when I look at DKS, hey, buddy, I got like tons of friends on here. How much friends? I don't know. I got thousands of friends.
Thousands of friends.
It is a lot.
You know, Tyler, this can be very distracting as an instructor. There's no doubt about that. As somebody who has as many kids as you do, young man, I have been distracted many times. But I can tell you on our end, all we're seeing is a cute dad teaching people how to trade, and it's awesome.
Listen, it's a sign of professionalism that I don't jump out of my chair and actually look. This is a test.
It is a test.
What's the word? How much can you pay attention to me without the distraction in the background? Okay,
dude,
like
he's
engaged?
He's a pretty cute kid.
I mean, look, he's like 50%.
You're being generous on that. Mother's looks.
Look, it's 10% me. It's 90% the wife. That's
how it always is.
Let's be honest. Okay. So with DKS, you could put your stop under 4 days ago, I think, or you could put your stop under the pivot low if you're going off the weekly chart, right? So either one. Here's the last thing I want to show you, though, in terms of how you have less risk with the call. Okay, you can use a risk graph, and this is a completely additional conversation. But in Thinkorswim, you can right click on the order and go to create. Analyze trade, and then it's going to bring it over to the risk graph. Okay, and this essentially gives you a picture to go with your trade. I'm not going to get into all the details, but I want to show you this though. I can basically say, where is my stop loss going to go and how much money will I lose? Okay, so what did I say? I put the stop, let's say below 4 days ago, because I really think, I mean, ideally, I don't want this to go back below this little pivot here. So 119, let's say, is my stop loss. I could put my cursor at 119 and it says, hey, you're risking about 450 bucks. 450 bucks. Well, look, that's about 40% of what I paid, $400 versus $1,000. So you can limit your risk even less than the cost of the trade, you know, with the stop loss, if that's your gig. So let's say I'm risking 440. What if it goes where I want it to go? You know, what if it gets up to this? I'd say probably first target, maybe 138, 137 and change, and then second target, 147.
100% right. T1, 137, T2, 147. You're walking up the stairs on this one.
Yeah. So you look at that on the risk graph, 137, you're making 600 bucks. 147, you're 1,400. So it's like, okay, so I'm risking $400 to make whatever I just said, 700 to 1,400. Yeah, I mean, the risk reward kind of corresponds with what it would be with stock, right? To a certain extent. So conceptually, that's the long call. That's some of the vocabulary. That's the call option specs. But visually, if you didn't understand all the mumbo jumbo behind it, this is what it looks like. You make money as the stock goes up. You lose money as the stock goes down. The Greeks and everything can just help you understand why you're making or losing money.
Well, Tyler, this was absolutely fantastic. And you know what? Your concentration was really, really good. That kid is, man, he's cute. He's coming up and he's doing his thing. But at the end of the day, he just wants to learn from dad. He just wants to learn how to pop a call option. That's all he's doing. He's like, I can make $1,400. Let's do this. Tyler came in to give our YouTube community a basic webinar and an understanding of how to trade call options. Thank you so much for doing so. I'm sure our YouTube community is going to be extremely happy with the content you are providing, and really do appreciate that. And for those of you who are not part of Tackle Trading, if you have found us along the way, we are Tackle Trading. We're a community of like-minded traders. We put out a bunch of reports. We put out long-term analysis, covered call analysis, short-term trading analysis. And this is a great time to be a part of tackle trading. We're coming into the end year, and at our end of the year, Team Tackle knows what we do. New Tackle 25 coming down the pike, new dirty, sexy money coming down the pike, great cash flow systems being updated for the end of the year. And as always, you can get access to all of our reports every single week on swing trading and utilizing everything that Tyler is discussing in the options report, which he also does for our pro member community on a weekly basis. So Coach Tyler Craig, thank you so much for coming on and giving us your wisdom here tonight. Really do appreciate that. And distractions aside, that little kid can come anytime. Anytime. He's fantastic. But we are Tackle Trading. Guys, this is Tyler Craig, Matt Justice. It has been a pleasure to hang out with you guys here on Monday, October 25th. If you've enjoyed the webinar, like, share, let somebody else know about Tackle Trading if you enjoyed as well. And if you're ready to give us a test over there at Tackle Trading and a pro membership, you can email team@Tackle Trading, and you can always just go to the main storefront on tackletrading.com and get access to all the pro features we put out there for nice little 15-day free trial, guys. That's the offer. Come test it out. Come enjoy everything that the pro members enjoy. And with that said, we are out 2 weeks from now, though. 2 weeks from now, we're going to be doing another direct to tackle webinar series, Tackle Trading 101. Topic to be named very, very, very shortly. Working on that as we speak. But I will be your instructor in 2 weeks from now for our next edition of Direct to Tackle, Tackle Trading 101, Basics of Trading. We'll be back with you in 2 weeks from now with another educational webinar. Until then, every day you can catch me, Tyler, and other coaches of tackle trading in the halftime report or over there in our pro member Discord channels as well. Until then,